Something is seriously wrong in the UK housing market. Brand new homes built to solve the shortage are sitting empty for months. No buyers, no interest, just rows of vacant houses nobody wants. Here are the 15 cities where the crisis is hitting hardest, starting from number 15. Number 15, Newport in Wales, represents the absolute worst situation of any town in the United Kingdom right now. It has the highest shop vacancy rate of any town in the entire United Kingdom, at 19% of high street units sitting empty. Nearly 1 in 5 shops is completely closed with no prospect of reopening soon. The town loses almost 5% of its high street spending to Cardiff every single week. That spending leaves Newport's local economy depleted and it does not return. Newport has between 2.5 and 2.9 shops per 1,000 residents, far above the sustainable ratio for its spending base. This oversupply is structural. The vacancy problem will not be solved by economic recovery alone, because there are simply too many shops for the number of people who can afford to use them. Property in Newport is inexpensive, but headline economic indicators point clearly in one direction, downward, and show no signs of reversal. 14. Bradford has an 18% shop vacancy rate, the second worst in the UK, according to Centre for Cities data for 2025. This represents one of the highest concentrations of empty retail units anywhere in Britain. It ranks second worst in the PwC Quality of Life assessment of all major cities surveyed. The city features among the most deprived urban areas, with multiple neighbourhoods in the worst decile for income, employment and health. Bradford was the UK City of Culture for 2025, which generated significant attention and some investment in the centre. However, the structural economic problems that drive the vacancy rate, the deprivation measures, and the population outflows all predate the cultural designation and remain completely unresolved. Bradford's property market is bifurcated, with outer suburban areas performing differently than inner city areas. Inner Bradford property remains significantly undervalued and is likely to remain so. 13. Blackpool's vacancy rate of 17.6% ranks third worst in the UK, according to Centre for Cities data from 2025. The crime rate reached 154.4 crimes per 1,000 residents in 2025. Seasonal employment creates income instability, making consistent retail spending impossible. The seafront economy and inland residential economy are essentially separate towns sharing a postcode. The residential economy has been in structural decline for 2 decades. Property has long been the subject of investment pitches promising regeneration. Some seafront regeneration has occurred, but inner residential areas have seen no equivalent transformation. The indices of deprivation 2025 place significant parts of Blackpool in the most deprived decile nationally for housing quality and health. 12. Walsall is ranked bottom of the Good Cities Index for quality of life, last out of 50 major UK cities assessed. The analysis cited the second worst high street health in the country, the third worst job market, low average incomes, and difficult healthcare access. These 4 factors are not independent, they compound one another continuously. Low incomes reduce high street spending. Poor job prospects accelerate out-migration of working-age residents. Healthcare access issues reduce quality of life for those who remain. The Walsall High Street vacancy rate has grown consistently. The property market reflects the underlying economics, with low prices and shrinking buyer pools nationwide. 11. Stoke-on-Trent. Centre for Cities spending data reveals a specific pattern in the city. In Bradford, Stoke and Wigan, just £1 in every 10 spent on the high street goes to food and experience, the category that has kept other towns viable. Stoke's retail offer has hollowed out completely, spending power has not recovered, and spending patterns have not pivoted toward an experiential economy. The Potteries shopping centre has struggled with vacancy. Town centres in Hanley, Longton and Fenton each have units lying vacant for years. Stoke ranked poorly in PwC and Demos quality of life assessments. Property is inexpensive, but reported yields conceal vacancy rates, maintenance costs, and a limited pool of professional tenants. Middlesbrough places among towns with between 2.5 and 2.9 shops per 1,000 residents, far above a sustainable level, meaning the retail vacancy problem is structural, not temporary. The town loses spending to nearby Darlington and to out-of-town retail. The indices of deprivation 2025 identify Middlesbrough as among the worst nationally for health outcomes and income deprivation. The Teesside Freeport has generated investment announcements, but the timeline from announcement to employment to economic impact is measured in years, not months. Property investors who bought on Freeport optimism in 2022 and 2023 have found the market has not rewarded that optimism yet. Those considering buying now are pricing in a transformation that may come, but which has not arrived. Hull consistently appears in the worst performing lists across multiple indicators, including retail vacancy, deprivation, health outcomes, and economic growth. Centre for Cities data shows Hull is one of the towns where the high street model has failed structurally, not temporarily. The city won the United Kingdom City of Culture title in 2017, which generated genuine optimism and some investment. In 2026, the lasting impact on underlying economic indicators is modest. The waterfront has improved, but outer residential areas and the town centre beyond the cultural zone remain challenged. Property is cheap, but the gap between cheap and genuinely good value depends entirely on whether the indicators that drive long-term price growth improve from current levels. 8. Hartlepool is among the most severely deprived towns in England for income and employment, according to the indices of deprivation 2025. It is not only a northeast issue, it is national. The town lost its industrial base, and it has not replaced it. The high street vacancy rate reflects a local spending base that cannot sustain the retail infrastructure that is available. A nuclear power station provided employment for decades, but it is scheduled for decommissioning. A proposed replacement nuclear project for the area remains at an early planning stage, with no confirmed construction timeline that would generate employment within the property investment horizon. Property is extremely cheap in absolute terms, but the investor question is not price, it is the demand side. 7. Sunderland's industrial base of shipbuilding, coal and manufacturing collapsed over 3 decades, and the city is still paying for it. The Nissan plant at Washington provided employment and an economic anchor, but 2025 announcements about production shifts introduced uncertainty into what was the city's most reliable private sector employer. The city centre has a high retail vacancy rate, and spending patterns do not support available units. Property in Sunderland is inexpensive, and net migration data shows more people leaving than arriving consistently. The fundamental challenge is that young professionals and growing families who would ordinarily absorb property sales are the people leaving. 6. Grimsby has been declining for longer than most towns on this list and shows no credible signs of reversal. The collapse of the fishing industry stripped the town of its economic identity decades ago, and replacement industries have not arrived at the scale or speed required. The Humber Freeport designation brings occasional announcements of investment, but the employment generated is insufficient to reverse population loss or to revive the high street. Grimsby's vacancy rate for retail units ranks among the highest in the East Midlands and Yorkshire region. Property is cheap, some of the cheapest in England, and rental returns can look attractive until void periods, maintenance costs, and tenant turnover are factored in. Number 5. Scunthorpe faces significant post-industrial economic challenges without a convincing replacement economy. The steel industry that once defined the town has contracted dramatically, and the employment base has shrunk substantially, leaving younger residents with limited opportunities. The high street is suffering from structural vacancy, reflecting a weakened local spending base. Property prices remain depressed, reflecting the underlying economic fundamentals. Builders are managing completed inventory with lengthy sales cycles, and the population continues to decline as those who can leave relocate to stronger economies. Mortgage qualification remains difficult for remaining residents, and builder incentives have expanded significantly as completed homes sit longer. Property investors face uncertain return prospects in this market. Rhyl in Wales is a tourism-dependent coastal town facing significant structural challenges. The high street has been in steady decline for decades. Population demographics skew toward older residents, and there are limited employment opportunities for working-age people. Property prices have stagnated, well below national averages. Conversions to holiday accommodation have removed traditional family homes from the local housing market. The council faces increasing budget pressure because the council tax base is depressed. Younger professionals continue to leave for stronger regional economies. Builders struggle to sell new homes in a weak market. Property investors find yields insufficient to justify the risks of deploying capital in the current environment. Port Talbot in Wales faces challenges from industrial decline and limited economic diversification. The steelworks provided a historic employment anchor, but operations have contracted significantly. The town centre shows significant retail vacancy. Working-age population has been declining as younger residents relocate to stronger economies, creating out-migration. Property values reflect weak underlying demand, and the council tax base has weakened due to population outflows. Economic inactivity rates remain elevated. Property investors are reassessing their commitment to the market. Builders are maintaining a cautious approach to new development given demand uncertainty. Long-term population trends point consistently downward. 2. Jaywick and Clacton in Essex face coastal economy challenges combined with limited employment diversity. Tourism provides seasonal employment only. The local council faces financial constraints from a depressed property tax base. High street vacancy reflects weak local retail spending. Property prices remain subdued, reflecting weak demand. Population demographics skew older, with limited working-age opportunities. Outmigration continues as younger residents seek stronger regional economies. Builder activity is minimal given weak demand signals. Property values lack a catalyst for appreciation. Rental yields are insufficient to attract institutional investment. Local infrastructure is aging without adequate maintenance funding. 1. Wolverhampton is a city in the West Midlands facing significant economic headwinds. Over the past decade, it attracted new residential investment, but fundamentals have weakened considerably. Interest rate uncertainty affected confidence across the market. Employment growth has not materialised as anticipated in original development pitches. Younger buyers have remained in rental markets longer than projected, and mortgage qualification tightened, reducing the effective buyer pool. Builder incentives expanded substantially as completed inventory accumulated across multiple developments. Council tax adds significant annual costs beyond initial purchase estimates. The regeneration narrative that attracted initial investment has not translated into sustainable economic transformation. Construction accelerated beyond sustainable demand levels. The buyer pool contracted considerably and shows no signs of recovery. These 15 crisis cities and towns represent where structural pressures are absolutely highest across the entire United Kingdom. The data from deprivation indices, retail vacancy surveys, migration analysis, and council finances points clearly to continuing deterioration for years ahead. Property ownership is a long-term decision requiring extremely careful analysis of local fundamentals that extends far beyond asking prices and surface-level metrics. The pattern across all 15 locations is consistent and concerning. Retail vacancy rates exceed sustainable thresholds, making recovery mathematically impossible without population and spending growth that demographics show will not arrive. Council finances are under extraordinary pressure, with some authorities approaching technical insolvency. Net migration is negative in almost all locations, meaning the working-age population continues leaving. Employment opportunities have contracted or disappeared entirely. Younger professionals depart immediately upon graduation seeking opportunities elsewhere. Young families remain in rental markets because affordability barriers are insurmountable. If you are considering property investment in any of these 15 locations, understand that you are betting against fundamental demographic and economic trends. If you own property in these areas, realistic planning must include acceptance that appreciation will be limited or negative. Builder incentives will continue expanding as inventory accumulates. Rental yields will compress further as supply exceeds demand. Maintenance costs will rise on ageing housing stock. Council tax will increase to fund essential services for shrinking populations. The structural challenges are real and will persist regardless of interest rate cycles or government policy announcements. These 15 cities and towns deserve honest assessment without the optimistic narratives that real estate professionals are obligated to provide. The data speaks clearly to anyone willing to examine it carefully. Property values, retail dynamics, council finances, employment trends, and population flows all point unequivocally to sustained pressure across all metrics. The crisis in UK housing extends far beyond pandemic-era oversupply in London apartments or Manchester towers. It reflects genuine structural problems embedded deeply in regional economies that will require decades to resolve, if they resolve at all. The information in this analysis comes from Centre for Cities data, Indices of Deprivation 2025, Migration Statistics, and Council financial reports. These are not speculative predictions but documented current conditions. The 15 crisis locations represent the clearest evidence of where UK property markets face the greatest challenges and headwinds. Before making any property investment decision in 2026, examine this data yourself rather than relying on developer claims or agent optimism. Subscribe now for continued analysis of UK housing markets. Thank you for watching.